Good morning, everyone. I know it is not easy to come on a Saturday morning, and then I'm sure last night some of you shown your face in the Coup d'etat, Avalon, and then bars along the Marina Bay area, so I am very glad that you guys will be here. And then make sure you have put your name card for the lucky draw of the mini iPads. Initially, we only have 2. Right now, we give it to 5. So your chance of getting a iPad mini is very high. It is my privilege, right, to introduce our speaker for this morning, which is an old friend of ACI. Anthony just told me that he was a member of ACI. Anthony is a senior managing director, chairman of the Greater China of the Blackstone Group, and a member of the firm's executive committee, and he is based in Hong Kong. Before joining Blackstone, Mr. Leung was the financial secretary of Hong Kong from 2001 to 2003. From 1997 to 2001, he was a non-official member of the Executive Council and chairman of the Education Commission. And prior to his appointment as Hong Kong's financial secretary, Mr. Leung has 32 years of experience of financial services in the industry. He was the chairman of the Asia for JP Morgan Chase, based in Hong Kong. And before that, he worked for Citi Hong Kong, Singapore, Manila, and New York for 23 years in various positions, including country corporate officer for China and Hong Kong, regional treasurer for North Asia, head of investment banking for North Asia, Southwest Asia, and head of private banking for Asia. And then Mr. Leung is currently also vice chairman of the China Blue Star Group, non-executive vice chairman of the China Merchants Capital, the International Advisory Board member of Beijing University's Guanghua School of Management, and chairman of the Harvard Business School Association of Hong Kong, and chairman of Kuifa International Hong Kong. I think Anthony is instrumental in bridging the economic connectivity between China and Hong Kong by signing the CEPA, the Mainland Hong Kong Closer Economic Partnership Arrangement in 2003, and thus offered a new direction for the Hong Kong to develop its economy. And today, he will share with us his invaluable insights on China economies and also the impact of China on the world economy. So ladies and gentlemen, please give an energetic welcome to Anthony.
Well, thank you, Andrew. Good morning, ladies and gentlemen. It's good to be home. As Andrew said, I was actually a member of ACI, but that was, if I count, 38 years ago, maybe before some of you were born. But indeed, it is a pleasure and privilege to talk to you. And as we are speaking, in Beijing, they are now deliberating the lineup of the new cabinet. And this new cabinet, I believe, will lead China to another 10 years of rapid growth. And since we are talking about the next 10 years, I think it would be useful to talk about what has happened to China in the last 30 years, because history does inform the future. So if I may, present you a chart that you are now very familiar, and that is the rapid growth of China in the last 30 years. And I think it may be useful to recount the events, the major events that may have informed and in a way affected China. That began with the reform in 1978, where they have a party congress and where they decided to adopt a policy of reform and opening up. There on the left-hand side of the chart, it talks about the reinstatement of university enrollment. Because of the Cultural Revolution, they did not enroll university students for quite a number of years. Then they have the reform in agriculture. Then they open up themselves to foreign investment in 1982. They decentralized the state control on many things reopened the stock exchange in 1991. They privatized some of the SOEs in 1996. And then, most significantly, after many years of negotiation, they joined the WTO in the year 2000. And that marks also the beginning of the rapid growth of China. And as you have seen, the curves, both the GDP and the GDP per capita, in a way, rushes skyward. And right now, we are looking at a China with a total size of close to $9 trillion on a nominal basis. Obviously, some organizations would count on a per capita basis, and there would be somewhat like 14 trillion. On a per capita basis, Chinese people are now making more than $6,000 a year, qualifying to be probably in the middle income group. So for the last 30 years, especially in the last 10, they've done extremely well. Now, the key drivers, the first one that obviously will not escape your eyes would be the rapid increase in the fixed asset investment. They've been investing a lot in infrastructure. A lot of people that have gone to India and also China would contrast the difference between the two countries. Mindful to say that India is also catching up, but obviously China has the head start. The infrastructure investment has been financed mainly with domestic savings. As you can see, this is a graph for gross domestic savings, and China, in a way, tops all the large countries. The savings has also been used to finance investments in education. Now, we Chinese have always placed a lot of importance on education. And that is something that I believe is easy to understand, because for thousands of years, education is the way for the poor students to somehow propel themselves up the social strata. I believe there's probably something wrong with the left axis. Actually, the university enrollment in China every year is more than 6 million. So the total university student number in China is now over 25 million. And actually, there is one also interesting observation, and that is among the university students, more than 1/3 are actually in the science and engineering discipline. So in a way, we are talking about more than 2 million new engineers or science graduates every year. And when these numbers are compared to many of the Western countries, in a way, it scared them off, because for some smaller countries, the number of engineers every year being graduated is actually more than the total number of university students. And that, in a way, also drives the rise of the Chinese manufacturing, obviously in the past from OEM, now to more ODM, original design, and then going forward, maybe our own brand and our own innovation. Joining the WTO have seen the Chinese trade rising tremendously. Now the export tops $2 trillion a year. Now, because of the heavy emphasis on infrastructure and export, we have seen that the proportion or composition of GDP, the proportion of the domestic consumption has declined. But it doesn't mean that China is not consuming. The Chinese consumption is still growing year on year. Now, obviously, a lot of foreigners may want to see it at a bigger percentage, but on the other hand, now that with a higher base, to grow on average 10% a year is actually not an easy task. We have seen the rapid growth in China for the last 30 years. The question, obviously, what will happen in future? The last 30 years of growth has come without no problems. There is growing inequality between the urban and the rural areas. There is very large income disparity. The Gini coefficient of China actually tops many of the Western countries. There is tremendous East-West divide within China, not between China and the West. And we all know about the environmental damages. Everybody talks about the pollution in Beijing. They use the PM 2.5 index as a measurement, and I must say it is bad. Obviously, for those that go to Beijing often, will see from time to time there are clear days. Whenever the wind blows, you have a clear day. If not, then the pollution can actually be very bad. And the consequence on health for the citizens and on the economy for the country cannot be underestimated. Natural resources has been degraded and is also affecting a lot of people. Corruption is a problem, and it is admitted by the party. China itself knows that in order to sustain the development, they need to change the so-called business model from the past, basically an export-driven and government investment-driven, to one that will emphasize on domestic consumption and the private sector. It has been stated clearly in the 12th five-year plan. But the question is, how will China be able to achieve sustainable growth, especially not just in the economy, but also in the context of social, environmental, and political areas? And we all obviously recognize that such a change will take time. Now, talking about time, obviously, there are a lot of people count the story about the different perspective of the Chinese in looking at time. There's this story about Henry Kissinger visiting China for the first time on the so-called stealth visit. When Henry was sitting in the study of Chairman Mao, they ran out of pleasantries. So Henry Kissinger asked Chairman Mao a question. Chairman, what do you think of the French Revolution? Chairman Mao paused for quite a while and replied, he said, Henry, it is too early to tell. Now, obviously, China having a 5,000 years history, look at history differently, and we all recognize that economic reform and reforms in China of the other sectors will take time, but I hope that they will not use exactly the same yardstick. I believe that China will continue to grow. I believe they will avoid what the Western economies are describing, the so-called the middle income trap. And the reason for my optimism really is based on a number of trends and a number of drivers. And here they are. And I will explain them one by one. First and foremost is urbanization. Some economists have actually said that in the last 30 years, urbanization, taken in the broadest sense, accounts for over half of the Chinese growth. In the past, if you look at the graph in the lower left-hand corner, the urbanized people, as a proportion of total population, increased from 18% just before the opening up and reform to now just over 50%. And the target is to go to 55% in the year 2020. If we compare with an average so-called developed country, particularly in the West, the percentage is around 75 to 85%. So if we are marching towards that stage, we are really talking a lot of people moving from the rural sector to the urban sector. Roughly, if you take 1 to 1.5% of population a year, we are talking about 15 to 20 million people. That is the size of Australia every year, moving to the rural, from the rural to the urban sector. Most of these people do not have adequate welfare in the cities. And the reason why we believe that this transition will drive growth, particularly driving domestic consumption, is the difference in spending, both in the quantum as well as in the mix. The number is a bit dated, but I believe the trend is clear. The retail sales per capita of the rural sector is much lower than that of the urban. But if you look at the mix on the left-hand side, they actually are spending on very different things. The urban people spend a lot on items such as computer, mobile phones, TV, as well as not captured here on services. Services, including education, the urban people will be spending a lot more. And all these, particularly on the services, will drive domestic consumption. And as a result, the income mix of the people will also be changing. Now, if we take the kind of segmentation by family income of the so-called middle class, and the definition of middle class obviously varies. If we take the kind of a very broad definition of 25 to 100,000 a year, it is expected to reach, I think the number is understated, I think it will be more than 300 million. Right now it's more than 300 million. I believe the number is going to grow quite significantly. And there are a growing number of so-called global affluent, which all of you belongs. However, China is growing rich and yet also growing old. Aging population is a problem, but in the process of aging, as we all know, the savings capacity of the getting old people is actually the highest. So we'll continue to see the savings rate maintaining very high. Now, don't ask me when the population has peaked, by the year around 2030 or so, if they don't change the population policy. But China indeed is getting old. And if you project to 2050, if we don't really change the population policy significantly, the dependency ratio, meaning the amount of people that are kind of working to support the not working, would deteriorate extremely fast. On the right-hand side, we see the life expectancy of the different countries, including China. China is now around 74, compared to Hong Kong and Singapore of around 83 to 81. I believe China is marching towards that stage, and that will create a major problem for the economy. But on the other hand, it would drive a lot of opportunities in the meantime, including the improvements in healthcare. We talk about Chinese spending on education. This is the education pyramid. Illiterate is actually fairly low. It's about 6% in China, compared with some of the other countries in the developing world that is a lot higher. I talk about the university education. They allow, as I said, more than 24 million university students in China, and that number may actually continue to increase. And this, the improvement in the labor quality, also is a factor why Chinese have been growing and will support the Chinese growth going forward. Another trend, another factor is a new phase of industrialization. China has been modernizing its own industry, but on the other hand, in the past, they focused on the high labor content, meaning labor-intensive, low-tech, but now I believe they're shifting to the higher tech area. They're already one of the top countries in registering the number of patents around the world, and the number is actually increasing. Clearly, some people have said China has been very good in copying, but I believe that is just the stage of development. I forecast that China in future would follow the path of Japan, South Korea, initially copying, just doing OEM, but later on will have their own design. And later on, at some point of time, they will also be one of the leaders in innovation and creativity. But in the industrialization, you also see that there will be an increase in the private sector involvement. If we look at the secondary industries as well as the tertiary sector, on average, we are talking about 60% of private sector involvement. But in the tertiary industry, as listed here, there's still a lot of room for improvement. And so for opportunities such as the Western strategics, meaning those that have technology, those that have the marketing skills, those that have the management skills, helping the various Chinese industries to improve will still be a great opportunity. And one of the areas that I believe will be focused on will be in the area of environmentally friendly energy savings, as well as in alternate energy. Clearly in the areas of the biotech, biomedicine, including even in areas such as nanotechnology, including obviously information and communication technology, all of these areas will receive a lot of attention. And some of these indeed has make it to the 12th five-year plan. The industrial upgrading in China actually has been significant. If we just contrast the export content of 1980 versus 2011, the lighter blue represents is actually the reverse manufactured goods, and the deeper blue would be the primary goods. You have seen a significant change in the mix, but obviously the most significant change is the quantum. In 1980, we only export 18 billion. In the year 2011, is almost 2 trillion. One area that is worth paying attention to is the IT or the e-commerce side. And this is an area that I believe will also continue to grow very fast. On a year-on-year basis, e-commerce has been growing in the last 5 years at almost 100% CAGR, meaning on a compound annual basis. And it's forecast to grow at well over 35%. I think initially would be more than that. Right now, every day, over 200 million consumers are going online to do shopping. Last year, one firm alone, Taobao, cleared 1 trillion yuan in trade, and the number is growing at 60% a year compound. So the total number of e-commerce retail sales in China is forecast to exceed the United States. Now, obviously, if you take it by the much larger population, it should not be a surprise. The number, the so-called penetration rate in China is still low. If you look at the right-hand chart, only 36% of the shopping is done online, so-called penetration, versus the United States of 73%, which is almost double. So if you take the trend and go to the average of the United States, you can see the tremendous potential. Internet penetration as another proxy, we still have room to grow. Contrast with US and Korea, which is the #1 country in the world in penetration of internet, China yet still have room to double. And this is an area that would throw out all kinds of opportunities, not just in the online sector, but also in the related areas such as logistics, after sales. And this, I believe, is an area that will be receiving a lot of attention from the investors. Another area that we seldom talk about is actually agriculture, because China, being such a large percentage of the world's population, almost 1/5, has only 7% of the world's arable land. And another issue that obviously people are concerned about is the food safety. It is also a problem alongside the pollution issue. So how do we feed the world's largest populous country is a concern. Now, if you look at the demand for meat, the right-hand corner, China already is acting on a per capita basis as much meat as South Korea and Japan, even though these two other countries have a much higher per capita income. So I think one other area that people may forecast is that the number of obese people in China will actually increase, and that may well be another area of investment opportunity. But on the other hand, feeding China can be an area of opportunity as well. We hope that China can achieve self-sufficiency, and right now we are consuming a lot of the fertilizer, and I believe we need a lot of help in the other areas as well, including in the biotech and bioengineering. I talk about the arable land as a percent of population. We are actually one of the lowest in the world. Another factor that will propel Chinese growth is what I call marketization. Some people may actually refer to privatization, which I tend to avoid the word, because privatization may actually mean taking a state-owned company and just selling it off to the private sector. We have done it for some sectors, but going forward, I think what may happen is that they would just take various measures to increase the private sector involvement in the various sectors, including in the so-called restricted sectors. People have pointed out the difference between the state ownership of ICBC versus, say, DBS, the Development Bank of Singapore. Right now, the state owns 70% of ICBC, as well as the larger banks in China. The 4 state-owned banks are all majority-owned to that extent by the state. Whereas in Singapore, I believe the Singapore government controls or directly owns about 30% only. And so we believe that there is a good chance in the next 10 years, and maybe even in the next 5, there will be reduction in the state's control, or at least the ownership of these state banks, as well as in other sectors. Also, I believe there may be policies that will be coming out to allow private sector involvement in many of the sectors that are now dominated by the state-owned firms. And that clearly would have opportunities, not just for investment, but also in propelling Chinese growth. We all know that, and the Chinese government admits that private sector, the efficiency and effectiveness is higher in the private sector than in the state-owned. Clearly, there are some sectors that the state would maintain relative control because of so-called strategic reasons. But if there's such a move of marketization, I believe it itself would drive Chinese growth to the next stage. Already they are making progress, such as in the provision of capital. Bank lending clearly accounts for a large chunk, but that percentage already is declining. Clearly, people talk about the development or the need for development of the non-banking sector. That, I believe, is in the plan of the government. Exactly how it's going to roll out is something to be seen, and maybe the panel can discuss that. But that yet is another area of opportunity, and again, that is a driver of the Chinese growth. Another one is globalization. China was completely isolated during the 70s, during the Cultural Revolution days. And then they opened up, and as we have seen since joining the WTO, trade has been increasing as well as investment. This is the total stock of foreign direct investment, inwards and outwards. On the inward side, they have reached 800 billion. On the outward side, it's increasing very fast, soon to exceed 500 billion. And this globalization will also in turn mean higher growth for China, because it will import technology, management skills is opening up new markets. And I believe in the next stage of the going out policy, Chinese companies would be not just buying resources, but also going for companies that would have the management skill, the markets, as well as the brand, together with the technology. So with all these drivers, in conclusion, there will be, I believe, continued rapid growth in the next 10 years. Obviously, that is barring unforeseen circumstances, such as a war or territorial conflicts, because once that happens, it will change the external environment of the Chinese economy. But barring a major military conflict, I believe all these drivers that we have talked about will continue to drive Chinese growth. For us in investment, there are key themes that would jump out from these charts, from all these key themes. The rising domestic consumption will benefit the consumption sectors such as retail and all those that are related to it. Urbanization will drive infrastructure as well as the real estate investments. People are obviously focused on the current measures to try to contain the price of real estate, but that is mainly on the residential area. But there are other real estates that investors can invest in, such as in offices, in retail, and in logistics, which I talk about, particularly logistics as it relates to e-commerce. The rise of the middle class will change the consumption pattern, so investments in areas such as education and other services, I think, would be a good area to look at. The aging population, healthcare, not just in the services sector, but also in pharmaceutical as well as in devices. Industrial upgrade I talk about, if we can find and help Chinese to upgrade their industries, and particularly focus on areas that the state have said that they will be working hard on environmental kind of energy savings, alternate energies, as well as in the other industrial upgrade areas. IT is an area, agriculture, but not just in increasing the quantum, but also in improving the quality, addressing the food safety issue. Marketization, there will be continued reform, and reform not just in the percent of ownership, but also in the composition. Particularly in financial services, I believe there will be reforms. Reforms may be gradual, but directionally, I believe they will allow the private sector, including the foreign-owned sector, to increase their shares. Globalization, if we can find strategic partners in China and maybe outside to help Chinese integrate into the global economy and play a much larger role, that can be an area of opportunity. All these are trends. Clearly, one of the questions is, will the new leaders be able to take China forward? And there are questions as to whether such a so-called wholesale change of leadership, once every 10 years, is a good thing. Some people have questioned whether there will be a shift or even a major shift in policy now that the leaders are coming in. Now, clearly, Chinese, we may have changed the persons in charge, but on the other hand, remember this is a kind of a country ruled by essentially one party, and the party has tremendous consistency in the last 30 years. So I believe that there won't be major shifts in the policies, because after all, many of these policies that are in place or have been announced have the involvement of the new leaders as well. So the policy would be consistent, and if we look at the new lineup of the leaders as one of the more experienced and wiser person that have dealt with China for the last 40 years have said, every batch of new leaders in China are more rational and pragmatic. If we look at the top two leaders, the president as well as the premier, they both have doctoral degrees, have experience working at the grassroots level, speaks a bit of foreign language, and have visited the Western countries a great deal. I have full confidence that the new leaders can take the country forward and maintain the high growth as well as maintaining social stability for the next 10 years. Thank you very much.
Anthony, thank you very much. Stay where you are. If you don't mind, please take a seat. Don't feel too lonely. We're bringing our panelists up for our next session. It won't take long, everyone, so if you would remain seated, we'll just bring our panelists up to get going and to continue talking about China and Asia this morning.
I'll sit down on the end and you guys can sit. Okay, you sit in the middle.
Super, that was a very fast turnaround. Thank you very much. So we had a great introduction there to China, and I was reminded that a few years ago, when the US markets caught a cold, everyone else in the world sneezed. And it seems over the last few years, now when China has a little hiccup, the rest of the world coughs, sneezes, and takes notice. And that's happening more and more in terms of the world and how we're exposed to Asia. So now we have an expert panel to discuss China and Asia and the impact on the rest of the world. And joining us, along with Anthony Leung, our panel moderator for this session is Michael McDonough from Bloomberg. I'll forgive him for that. Michael is a senior economist and primary contributor to the Bloomberg Brief. He's based in Hong Kong. Anthony Leung, doing double duty as keynote speaker and panelist. And Brian Baker is CEO of PIMCO Asia with $2 trillion in assets under management globally. Fen Gao is the president of Deutsche Bank China. Anita Fong is CEO of HSBC Hong Kong. Leslie Teo, chief economist of the Government of Singapore Investment Corporation. Thanks to all of you for joining us.
Thank you everyone for coming. And that was a very interesting presentation. And I thought a good way to open up the panel would be to get some reaction from the other panelists on the presentation and maybe give Anthony a question or two themselves. Would anyone like to begin? Brian, put it on you.
Thank you very much. Mike, you're a good friend. I guess there have been very few instances historically where countries have avoided or smoothly transitioned into the middle income gap. And I think one of China's challenges is that it has a very aging society. Is it able to make that transition smoothly and quickly enough where the economy gets, or the country gets rich before they get old?
Should I wait for all?
No. You can go ahead and answer.
Well, I think that clearly is a key challenge. And if we kind of bring it not just to the Chinese context, but on the global one, some entities have actually said the challenge to the world because of the aging population is actually many times that of the financial crisis that we have seen in the last few years, because the so-called savings shortage, as well as in the other challenges would be something that the world, or most of the world, have not really awoken itself to. I believe China is trying to address that in multiple ways. One is to see how they can provide, let's say, social security, or at least the necessary welfare for this very large group of aging people. So I think we'll probably see reforms in the welfare system in China. And I believe alongside with aging, there's the urbanization issue, and these two may prompt China to undertake fiscal reform. Because, as an aside, if you look at the Chinese fiscal system, the central government collects around 53% of the total revenue in China, but directly spends only 20%. So the rest, a lot of them are actually allocated back to the local governments for spending. Some of these are actually related to welfare. And in China, if you're in the rural sector, when you work in a city, you actually do not get welfare after a certain kind of stage. Like for senior high school, people do not get welfare if you are from the rural and you have not changed your registration system called Hukou. So that, I believe, will change. And so a changing on the social welfare may address some of the issues of aging. Another would be, I believe in the next 10 years, there may be modifications to the population policy. But whether they will be in time to very significantly change the dependency ratio is obviously a question. I don't think that they would just lift the birth control policy or population policy, but some relaxation actually would probably moderate the aging problem. So I believe in the wisdom of the Chinese leaders. I believe this is a problem that they are addressing. But clearly, there are other experts on the panel that can talk about this.
Actually, I sort of want to segue kind of to get more views on China's macro outlook. And we're talking pretty long term here. You know, we're talking 5 to 10 years. But I want to know, in the short term, this year, next year, does China need to feel pain before it could get better? I mean, rebalancing doesn't look like it's going to be an easy process. Consumption's already growing. Investment's growing a bit faster. So if you rebalance, you need to reduce the investment's contribution to GDP to increase consumptions, but it's not going to be able to fully offset. So does China need to experience pain, and how painful will that be before they could be put on a sustainable course? I think Leslie or Anthony, one of you could probably add some possibly insight on this.
Sure, I could give you my view.
Yeah.
Actually, I do have a question, Anthony, and maybe all of us on the panel. In your description, we didn't talk a lot, or one question I would have is all those trends. What about the financial sector? What do we see in the financial sector, in market development, in liberalization, capital account, and so on, to complement, I guess, all these trends? But to answer your question, and without parsing the question to me, I mean, does it need to? I don't think it needs to. Will it? It's an open question in some sense. But I would make a few observations. I know the temptation is to focus on the cyclical, and I would observe that we in the markets wax extremely optimistic or extremely pessimistic on China, especially in the last few years. Right? We have these bouts. I like to look at China from a more structural point of view and to be realistic in what I would expect from China. Second observation I would have is that in some sense, it is not inaccurate to say that China has had an easy path towards high growth over the last 30 years. Now, it looks easy because the Chinese have done it. We shouldn't ignore the fact that even perhaps 15 years ago, people had a lot of doubts about where China would be going. But it's easy in the following sense. One is there is catch-up that comes from a country that can just buy a new machine that can put people to university and upgrade very quickly. There's also catch-up from liberalization, from a centrally planned economy to a market-based economy. Third, I guess, observation is that do the Chinese understand where they want to go? Are they very clear on it? And here I think the leadership is very clear. They want to double per capita income growth over the next 10 years. They want to do this in a way that will not degrade the environment. They want to do this in a way that will sustain social cohesion, address the social income inequality issues. They want to deal with corruption. And they want to also do this in a way that's efficient in regards to the use of resources. I think, my fourth observation, my belief is the Chinese have the expertise, they have the resources and the creativity, and they have some time. And there's a lot of inefficiencies in the system that can be fixed to help this transition, right? But it is a difficult transition, the transition to a more balanced economy, because you have technical problems, financial sector liberalization, land reform, the hukou system, fiscal relations between the region, as Anthony said, between the central and the regional. And then there is the really big problem, which is, to me, a question about political and institutional reforms. And my answer, echoing what Anthony said, is that, look, at least for me, I have no insight into the minds of the particular Chinese leaders. I have no insight into the struggles that they face. But I have three things to work on. One is a 30-year track record of the Communist Party, which has been very pragmatic and which has made growth look easy. Second is the recognition of the problems. They're very clear, right? They recognize, actually they talk about these problems. And third is that the interests are aligned in a very broad sense, right? China's leadership wants to give its people that doubling of per capita income growth. So that is what I base some of my optimism on in a realistic manner. Like many countries, especially in the emerging world, but not just the emerging world, vested interests, corruption, very difficult problems have to be addressed. There will be setbacks and vulnerabilities. But on the whole, you know, I would echo Anthony's general tone. Sorry.
I guess my point is you listen to any policymaker and they say we will we'll address social safety nets, we'll address income inequality, we'll address restructuring the SOEs over time, we'll liberalize the capital account over time. Do they have that time, right? I mean, depending on what statistic you look at, labor growth is negative either today or in the next 5 years. These liberalizations and changes need to occur quickly, and can they, and will they?
Yeah, I think, you know, you were talking about pain. Obviously, I think I'm not sure that's a short-term pain, but the question from Brian probably asked about that. That is, you know, I think there are a couple of things. First of all, you know, is China getting older before it gets rich? The reality is, I think, you know, given all the factors, you're not really given a very good choice. Anthony talked about feeding the people of 1.3, 1.4 billion. And, you know, population policy, I don't think can move a lot, because that is a real constraint on the environment, on resource, everything. So, but there's also providing opportunities, right? You talk about, you know, the retail, you talk about consumption, you know, the social welfare, so that, and also efficiency issue, right? The system itself is not highly efficient. There's lots of efficiency can be derived, whether it's through a financial market reform or whatever. The past 30 years, I think now they're talking about the biggest dividend from the experience of the last 30 years has been the reform. I think China needs another reform, really the grassroots reform. The difficulty compared to the reform that started in 1978 or 1982 is that, you know, given the last 30 years, China has advanced quite substantially, and there's a lots of interest group being developed, right? You know, when you're starting from low level, you can really basically go in and do whatever you want. Now there's lots of things you have to watch out for, because, and that is, I think, if you will ask me, that is the challenge that, you know, the Chinese leadership will have to deal with. There's enough of a positive there that I think economy can still grow, but there's the difficulties we're going to face. It's not likely like what we have seen in the past. I think they need to deal with the new challenges.
Do you want to add something?
We talked about this pain. Does actually China, the leaders need to actually have some pain before they can really gather the momentum of growth. I'm looking at it from a slightly different kind of dimension. I mean, we all kind of look forward to the continued growth in China. I think there is very little skepticism in terms of the next kind of 3 to 5 years, whether it's going to 7%, 8%, 9%, but still it's going to be material growth in China. The thing I see from the Chinese side is, do you really need to actually be in a disastrous situation before you realize that you need to do something about how to sustain growth? I think you see all the signs that they're actually realizing and be proactively addressing these issues. If you think about the China growth story, over the last 5 years, phenomenon growth. And if you think about the entire kind of banking sector, which is the major engine to support growth, take alone the 2009, 2010, where you have the stimulus policy, the 9.6 and 7.6 trillion, loan growth, and then look at 2012, you have the loan growth of 16%, which is far higher than the underlying GDP growth. Now, if China is going to continue to grow in that momentum, just take a very conservative, whether it's 7, to 8%. If the China nominal GDP is just over 9 trillion, still the banking sector will need to contribute pretty much close to $1 trillion, 900, billion US dollar. That's a lot. I think the regulators and the government realize this, so they're trying to make reforms before it becomes a pain. So we do expect that within the next couple of years in particular, you have a more phenomenal growth in the onshore domestic capital market, which I think in all the kind of explicit expressions from the regulators, whether it's CSRC and the banking governors, they realize just relying on banks to support it actually is very prone to systemic risk. Now, that will mean that they need to do something. I mean, to really build a domestic capital market, we all know that there are a lot of shortfalls that China will still need to address to. For example, transparency, whether you have a good credit evaluation system, how you're going to consolidate the split markets to promote liquidity, and how you develop a pricing yield curve. Now, but at least they realize it and they're doing it. So I think I tend to take a more positive view towards how to actually sustain this growth, and I echo what Anthony just said, because we've actually got not only capable leaders, but I think the extended leadership team, they know the issues. But China is a big country, so this is not about a broad brush approach within a short period of time. You still need to maintain that gradualism, independence, and controllability over time.
Well, on that, China has been, as you pointed out, extremely dependent on credit for growth. You may disagree with this statement, but I'm pretty sure that as China rebalances, the growth rate will have to slow from where it is right now. Well, what impact will that have on the existing credit in China? There's quite a lot of it, so if they're slowing growth, you could see some stress in that market. What impact will that have? Could that become the pain?
Following on that, a slower down in terms of the credit expansion doesn't imply that you have a problem in your existing credit.
What about a slowdown in the growth rate?
A slowdown in the growth rate doesn't
of
necessarily
GDP.
Equivalent in terms of a problem in the credit, because a slowdown of the growth rate, depending on the underlying composition of the growth, that's what China is now focusing on the next 5-year plan, structural reform in terms of the underlying composition of growth. So if you're seeing like hypothetically a 7.5% growth versus previously a 10% growth, but more underlying is on the domestic consumption, actual real economy instead of just on the fiscal, investment, that is quality growth. I think that is basically what, I think the government or the country would want to aspire towards, a more balanced growth. But surely you need to maintain the momentum, because you still need to create this urbanization, i.e. the number of jobs. Kind of 15 million population migrating every single year.
I think Anthony wanted to add something.
Yeah, I think a lot of people are very concerned about the so-called rise in the problem loans in China of the banks. And obviously, for some of those money that has been raised in the non-banking sector, channeled to, say, the real estate and also to the so-called local government financing platforms. I'm actually less concerned as compared to the Western analysts, maybe partly because I was a director of ICBC for 6.5 years, and throughout the 6.5 years, I was the chairman of the Risk Management Committee. Just taking ICBC as an example, I believe a lot of these risks that are being portrayed in the Western press has been overblown. Take the real estate sector as an example. Ever since 2008, none of the mortgage loans were made with a equity less than 30%. And so even if the housing market, the prices across the board will collapse by, say, 25%, there's still equity involved, or there's still equity left in those loans. And we haven't seen a major correction in the real estate yet. Now, granted, if you look at real estate in China, China being such a large country, there are some cities that probably would have made bigger problems. But on the whole, because of urbanization, I don't really see as big a problem as the analysts may think. On the local government platforms, at least in the case of ICBC, 90% of the loans to the so-called local government platforms has cash flow, not just asset value, attached to it. So that is the situation of, say, one bank. But on the other hand, if you look at the macro level in China, because the Chinese government in general is not very highly leveraged. Obviously, foreign debt, as we all know, also I said the central government debt as a percent of GDP is less than 20%. And if you think about the macro, the gross savings rate of China is 50+%. So, and with growth, all these can actually allow the Chinese economy to absorb quite a bit of shocks. So I believe that while there will be sporadic problems and it would be kind of, should I say, it would hit the newspaper, I actually don't think the so-called problem loans is as big a problem as some of the Western press.
You wanted to add something about, but let me say, what about, we are seeing an early rise already in non-performing loans in China. Is that an anomaly, or is that not a trend?
No. I mean, because if you're talking about kind of a slowdown, it would certainly increase the NPLs. But the NPL increase would not really be big enough to rock the equity base of some of these large banks. I mean, I think the NPL of the largest banks in China are below 1%, even if they are so-called doubled. The loan provision ratio of most of these banks are actually over 2 times that of the NPL ratios. So before even hitting equity, they can absorb in the provisions.
Also, I think, I agree with Anthony. It is a bit of an overblown, but it is a problem. So let's take it from another angle. 12 years ago, when China started setting up asset management companies, that's so-called bad banks, right? 4 asset management companies took over about 1.4 trillion bad loans. That is about 10% of all the banking asset at that time. Right? Today, the banking asset is easily north of 100 trillion. Right? If you talk about 10% of that, we're talking about a totally different scale of problem. Social financing, if you look at, over the last few years, I think we're looking for a more diverse approach. Bond market going from nothing to now about 14-15% of social financing. So the banks, the growth is not entirely dependent on the loan growth, right? In the past, the central bank used to have a loan growth quota every year. That is getting less important. Now they're replacing it with the total social financing, meaning there's other means, right? Last 2-3 years, there is what they call shadow banking financing, right? To about 12 trillion. Just over the 3-4 years period through trust loans, right? So if you look at that in totality, the existing problem is not, I think, that scary. But however, it also pointing a problem that you really need to do something, because given the diversity, given the new things, I think, for example, trust loan, that's basically securitization. So instead of letting it run in the shadow, in the background, bring them to the front, right? Give transparency and let market know about it. So that is all is going to be driving from more rapid reform, I think.
Yeah, I think we are concerned about the credit-led growth of the Chinese economy, and you can, quantitative easing is done in many different ways around the world. In the U.S., it's the Fed buying mortgage-backed securities, U.S. Treasuries. In the U.K., it's the BOE buying gilts and lending to banks. In China, it is quantitative easing with Chinese characteristics, which is generating credit growth. And because the banking sector in China is highly regulated, banks are having to find other ways to give loans to borrowers. And what you saw was in late 2010, early 2011, credit growth was reined in, and you saw non-performing loans rise. And so then the government had to lower the restrictions because you've got borrowers who, if they can't continue to roll over their loans, start defaulting. Because the majority of those loans are given to local governments for infrastructure projects or to property companies. And we kind of look at the shadow banking system as a way for banks to continue to create credit without ruining their ratios they report to the banking regulators and ruining the balance sheets. And there are a number of ways they do it. There are these trust companies where, in essence, they buy loans off of banks' balance sheets, create funds, and sell those loans back to bank depositors. The marginal new participant in the shadow banking system are securities companies, which are making loans directly to local government SPVs and other high-yield borrowers. You have off-balance sheet loans that banks are making through letters of credit and guarantees. You have state-owned companies who are using low borrowing rates from banks and then passing that on to local governments through allowing their account receivables to extend, and we've seen that occurring. And then finally, we're seeing more and more corporate borrowing where local government SPVs will issue in the corporate bond market, and then banks will buy those corporate bonds. Another way of lending without putting those loans on your balance sheet. So it has become, in 2012, 55% of new loans came through this non-traditional shadow banking system.
So what's the result of that? What it could be the result of that? What's PIMCO's view will be the result of that?
Ultimately, if the government has to rein in credit creation, you start seeing rising NPLs. And those NPLs, because a lot of these NPLs have been sold through wealth management products, through trusts and securities companies, starts hitting the individual.
And it hits the individual. That has a wealth effect. If you're trying to increase consumption, that could harm or balance.
Exactly.
I think just one point to add to what Brian said is if we look at the social financing, it's about kind of 15 trillion. On the relative scale, in terms of the entire banking sector's total assets of about 110 trillion, where the loans actually is about 60 trillion. So that's the quantum of the social financing. But actually within that social financing, the part about the trusted loans or entrusted loans or the off-balance sheet contingent, which is the part that is the bank's implicit, but then is off-balance sheet, is about 3 trillion. So that's the quantum. What I want to highlight is there is an issue. The banks are well capitalized compared with a decade ago in terms of equity and capital. And I think the good thing is the regulators is aware of the quantum that they need to deal with. But I think the bigger challenge is, should you have some of these asset management products that is spun off from these kind of trusted underlying securities being sold to the retail and finally got a kind of potential default situation, then the reputation risk to the system is also one thing that we need to be aware of, which is, I think, what regulators are also watching very carefully. And if that happens, say, one of the underlying kind of entities within a securitized asset that's being sold by banks as a wealth management product, if there's any of the credit event, how do we deal with that? Because legally it's not on the bank, but the bank is selling these products. So the uptick from a retail, from the normal citizen, we think that I buy this product from a reputable bank. So there's some problem underlying of these assets. So where is this liability?
Right. So the banks need to find these alternative off-balance sheet ways to keep credit growing. Otherwise, the loans that are on their balance sheet start non-performing. So they need to meet strict regulatory criteria ratios. So they've done this off-balance sheet shadow banking system. How does that unwind? How does that end? You can't move those onto the bank's balance sheets, because then the strict ratios they're kept to by the regulators
They're not
turn bad.
Well, they're not going to move. It's not like SIV situation in the U.S. where you can move back because by legal structure, I'm of different view actually. The reality is actually I think Chinese market we need some high-profile default. Right now, you're trying to cover up everything's hunky-dory, everything's good. But, what China really lack is transparency, right? In the past, why, we talk about direct financing versus indirect financing, everything going through the bank. It's easier to go through restructure because nobody knows what is behind it. When you come to a public market, when information is in the public, I think, it's education for both regulator as well as investor. Right? You cannot really rely, if you buy a trust loan, Anita quoted like 3 trillion trusted loan. In the trust loan, there is in-trust loan and the trust company loan. That's very different. In-trusted loan is basically if company have spare cash in the bank, I want to lend it to somebody. You come in with eye wide open. And if you lost money, bad luck, right? In China, it's the same thing. Why there is still a situation where you buy a high-yielding product, and you think that is still the same credit as the selling bank. Well, the selling bank has nothing to do with it. Education in a small place like this, the investor need to come in, also realize what is the risk. 10% of yield doesn't come freely, right? If we are too concerned about, what is going to be the reputation or whatever, I think the market will never develop. That's why I've been calling for, maybe high-profile default.
So what would happen if there was a default?
Well, people lost money, right? Like in the early 90s when the stock market, people go in, buy the stock, and they lost money. And they're beginning, first couple of years, there are people parading and the demonstration on the street. But then they recognize there's a risk associated with it. So you come in with your eye wide open, and also you enforce the market to force the discipline. If you keep on hiding everything behind non-default, restructuring, all of those, the system will never develop. And people, next generation people still talking about, I buy 10%, the government has to give me back up. So everything will go back to the government balance sheet, right? So that's not good for the market. That's what I mean by, a higher efficiency when you need to develop through capital market. Bond market will be a good development. In the trust loans situation, if you put a formal sort of a securitization program on it, it's securitization. Then everything has transparency.
Well, I guess it's our view that yes, investors learned that investing in the stock market you can get losses. I think investors believe that the wealth management products will ultimately be backed by the government, the local governments, or the banks.
But you go to document, nothing backs that. So that's why, you
but I don't think the wealth management clients recognize the risk that they're taking on.
No, everybody, I have an account with Chinese bank, and I've been sold all of those. Every time you go in, you actually sign more restricted, more strict than a Western country. You sign a risk disclosure, and you basically you sign your name behind dotted line saying you understand the risk, and this is what you're willing to take. The reality is, I think for a lot of other reasons that you don't want to have unrest in your own region. You don't want to have people in front of your doors hanging a slogan there every day, so that you come in, you tolerate. It's like you tolerate bad behavior, and the next thing is you have even worse behavior coming.
Will a default? Do you think a default will happen this year? Will it be allowed to happen?
Well, I'm hopeful.
Hopeful.
Well, I think we saw that, again, coming out of 2010, 2011, they started to tighten because inflation was rising, and they started to see defaults rise, and the government laid off. And I think the government has implicitly allowed the shadow banking system to flourish, to keep this credit creation, which is driving growth, to continue.
Maybe, I think there are two parts to the question. One is it goes back to the question of how much pain you need, how fast, how soon. The more general question, which is that, and here's partly my answer, Brian. I mean, one reason why I say there's time, I think in terms of time, 2 or 3 years, is I would look very carefully at what social credit is doing, total credit, banking credit, but also what the Chinese call social financing. The other would be inflation. The question about social financing that's a little complicated is the impact of the 2009 and 10 cyclical loosening. Right? So the model has to change. We know that a model that's completely based on credit, investment, and so on and so forth, that's changing, but you have the impact of the financial crisis and the Chinese reaction to the crisis. They're trying to get a hold on that. If I look at the numbers, it's yes, if you look at credit in Chinese in total, it's grown very fast. It's probably 200%, so I'm using a different concept, a broader concept, 200% of GDP. You could worry. On the other hand, you could say, at the end of the day, who's going to bear this if there's a big problem? It's the government. It's the government's balance sheet relatively healthy. And it's the country growing at, well, if you don't have to be very optimistic, 7%. Can you earn your way out of some of the holes that are being created? That gives me some cautious, again, very cautious, not optimism. I would say, I don't panic, but this can't last forever. Right. Second point I would make on the NPLs is NPLs are a really bad indicator of the future, right? They don't actually appear until you're in a bad situation. There is no doubt in my mind that there's a lot of wastage and NPL in the system, not just in the banks, but in all of these. But again, it's a question of scale and how long do you push this before it becomes a problem. And that gives the fact that the Chinese recognize this and trying to address it is the time issue. Do you need a great financial crisis? Do you need the bubble to burst like in 2008 before the Chinese react? Or will they react now? And my reading is they've been reacting and they're trying to forestall that great bubble.
Yeah, I think what would cause the Chinese to start reining in on credit would be if inflation hit. Right? Inflation is the big concern. Throughout history, inflation has been involved or instigated many unrests around China. I mean, the transition from China from the Nationalist Party to the Communist Party occurred during a period of high inflation, high monetary growth. You know, the yuan to a US dollar exchange rate was 23.2 million to 1. So that's their big concern, right? And I think if inflation rose, they'd have to do something, and that would then cause the credit creation to slow, NPLs to rise, and I think that's their big concern. They're hoping that they can transition to a domestically led economy without inflation rising, and then transition from this credit-led economy to domestic-led.
It's of my view, inflation will start rising before the end of this year, so it'll be interesting to see what happens on that.
This year is the monetary policy is going to be tighter. I think it's going to be tighter. I think that's a good sign that people recognize the problem and they want to head it off, right? And
so this is a good segue then to focus a bit more on the development of the onshore markets, and I'll propose a question this way. If I got a QFII quota, what would I really want? Would I want it right now? And if I got it, what would I do with it? Where is the upside in China's market right now? And anyone? Brian, I think you guys are working on a QFII quota.
We are, yes.
So if you could do it, what would you, or anyone can answer this question really. Where's the upside?
I think that, the QFIIs are small, right? The biggest QFII quotas now are $1 billion, and that's given predominantly to central banks around the region, Norges Bank, another one. So they're small allocations. 50% has to go into equity markets. So it is from our view, it is a way for us to start participating in the second largest economy in the world, in a financial market that we think will continue to grow and develop, and a capital account that ultimately will deregulate. But the QFII quotas are pretty small.
Yeah.
I think when you think about a quota, there must be some meaning for a quota. Okay, so this quota is an allowance of companies or investors to be participating in the onshore market. If you believe in a China continuously open up and continuous opportunities, surely one will want to have a quota if you don't have one. And one would definitely want to have a bigger quota if you already have one, unless there are particular constraints that push you to invest in areas that you're not comfortable with or in percentage concentration that you're not comfortable with. I think that's the backdrop as to how I would look at the QP quota. Now, the thing with QP quota, as Brian said, is small, but so far, over 170 institutions have been granted a QP quota. It's about 40 odd, billion US dollar. It was increased to 80 billion. So there's every intention to actually allow more participation into the domestic market. It has not been easy, to invest in the domestic market because previously there is more kind of intention for investors to participate in the equities market, which I think over the last 3 to 4 years, it has not been an easy ride. But I think there has been every intention for opening up of the underlying investment categories and more freedom in terms of allocation of your funds into the domestic market. And given the fact that the domestic capital market is definitely poised to further growth in terms of the diversity and depth, I think it is welcome. But I think when you look at the QV quota, it's not only about the QV quota is in dollar, it's also in the RQV quota, which is also gathering a lot of attention in the offshore market. The RQV quota, first granted in 2012 in the beginning, has now been increased to 270 billion renminbi. Now, the interesting part of the newly granted QV quota, RQV quota, is they allow you to invest in the whole variety of underlying, including stock indices. And it's pretty kind of free in terms of the allocation. You do have some constraints in terms of a single stock holdings. And given that the accumulation of the renminbi will gather pace in both Hong Kong and also in the other cities, the existence of the RQV quota would also broaden the scope of investment products that is available offshore, that is going to build up the liquidity and also build up the capability of, the presence of renminbi being used as a currency, which if you think about in the long-term road of renminbi becoming a truly global currency, you need to have a kind of more turnover in your exchanges, your currency, and also representing trade and also representing capital market.
I'm going to, on that, I know...
But no, for QFI, let me add something. It's just to answer your question very direct, if we don't even go to the equity market, I tell you, onshore, offshore, if you do same bond of China, same credit, right now you have about 60 to 80 basis point premium, right? So on carry basis, that's a great trade. But that's, I think, way too micro. More macro picture is, Anthony has a chart talking about cumulatively China has attracted more than 800 billion US dollars of foreign direct investment. So QFI up to end of 2011 was 20 billion US dollars. And then last year was a big year, increase of 16 billion, almost double. Put that in perspective, right? Chinese equity market cap is 2.6 trillion US dollars. So QFI accounts for less than 1% before 2012. Now, last year's increase now is still less than 2%, right? I think the Chinese government, QFI is a very important tool for the government to use to test the capital account convertibility. If you on direct investment point, you have such a big portfolio. For portfolio flow, you also need a channel for the money to flow in and out. And right now, you open the door of less than 1%. And if cumulatively, every year you increase 20 billion, that's like probably 1% increase every year. Other developing countries at this stage of China's development, they have foreign participation of their capital market or whatever, close to 10%, 8, 12, what have you, right? So China is far from that. So QFI will be a very important tool. In addition to, you can take optimistic views on Chinese stock market and bond market. Also, it's a very good testing ground for the future of capital account convertibility.
I think one other change outside of those that Anita noted was that non-Chinese financial institutions are now going to be allowed to participate in RQFI, and I think non-Chinese financial institutions have better distribution experience, better distribution networks, and I think it'll grow the RQFI market materially.
And this actually kind of goes to the next question. So what is the potential for the domestic bond market, the onshore bond market, and also what needs to happen and when might something happen to make the domestic equity market less speculative?
Bond market is actually, right now if you look at bond market went from almost nowhere to total outstanding bond is somewhere about 25, 26 trillion. It's not small, right? Out of it's like even the corporate credit on the bond market right now is still treating as a loan replacement. That's like about 6-7 trillion. Not very small. So compared to that, I think it's come a long way. Is there more room? If you look at almost every parameter, there's a huge room of growth. Last couple of years have been really the period where I see rapid growth, especially in the interbank bond market. CSRC started high-yielding bond. They don't call it a high yield. They saw the small, less credit-worthy bond. But personally, I really doubt the liquidity of those because each of the issue is very small, and we really don't. But like I said, for that to develop, number one, I think the central bank is continuously going to get a loan growth quota, so people are going to look for replacement. And secondly, for capital market development, people really need to have, stronger investor base. Like for example, insurance and other fund managers get involved. You really need to develop that institutional investor base. You really need to have a system because right now all the rules and laws are there, but enforcement, right? You need to test the system, right? I talked about default before, not like for the sake of default. It's just like you run through a process, see how, if there's any bad situation happens, how this can get resolved so that investor will get more. They have much better roadmap, right? Say, next time I deal with this, this is the route I go through. And that's why how I value each of the credit in my, or price each credit in my portfolio, right? So that is, I think, the necessary condition for the markets to develop.
I think if you look at the bond market in China, as Gao Zong 说, right now we're talking about 25, 26 a trillion renminbi bond. Now that's about what, 4 trillion US dollar? It's grown a lot, but if you think about the quantum compared with the US, it's about 38 trillion. So obviously the bond market is still very, very underdeveloped, particularly in terms of how in the future it's going to be able to support the underlying growth of the real economy. The bond market has to develop, otherwise you will still continue have to rely on banks which are unable to support the continuous growth. So there is every single genuine need for development of the bond market. Currently the bond market is still mostly dominated by the Ministry of Finance issues or some of the policy banks issue. The real corporate bond sector is growing, and you have the deregulation of the interest rate on the going. So you would have more corporate definitely interested to tap into the bond market, but you need to have a better infrastructure, i.e. more transparency in terms of how to do the pricing, how to do the yield curve, what happens if you have a default situation, do you need to go through a contingency kind of practice if a default actually happened, how to actually gather all these kind of processes going, and do you have a credit evaluation, ratings agency, etc. Now the other thing about on the other side of the bond market, which I think I'm positive of the growth, is because you have the need, but you also need to have a demand. Now, you have a lot of demand to invest into the domestic bond market from offshore investors. The CIBM quota, what we call the China interbank bond market, has opened since 2010. Now, over 15 countries have been granted a quota. It's mainly banks, central banks, now supranationals and insurers are now being granted a quota. They're all interested to invest both as a tool for investment diversify and also a deployment of de facto reserve. surely be some role before the renminbi can be formally considered as a reserve currency. But central banks are keen to actually look at it. So you have the demand and also supply side, positive move.
Okay, so this market's developing right now. I'm going to use this to go to a question directly to you, Feng. So how big of a disadvantage are foreign banks operating in China versus the local counterparts? What role will the foreign banks play?
I told you not to ask that question because it's getting sensitive, right? But no, I will answer it this way. Foreign banks, we're new kids on the block, put it that way, right? The Chinese bank has been there very long, and so in terms of branch network, it's a disadvantage. You look at the total asset, the banking asset, foreign bank collectively, I think right now it's about probably 1.6, 1.7% of the Chinese bank. And China's banking market is still very much a traditional banking market. So a lot of banks, the wholesale banks, when you come in, you really have a disadvantage, put it that way, right? Because if you go analyzing the earnings capability of those, it's almost, I did all of those, it's almost proportional to, your balance sheet, basically. So with less than 2%, and so you're insignificant. What I like to compare that to, however, the positive view is if you look at some of the newer areas, like the derivatives, the hedging area, foreign banks accounts for a far larger proportion of the market than our capital and our balance sheet. So that is actually very positive, right? As market develop, we see interest rate liberalization is coming. We see foreign exchange liberalization has been largely coming, and that is going to be all favor us. So it's not all negative, but currently the constraint is there. You cannot open your branch fast enough. I think the biggest foreign bank has 100 odd branches, and you talk about 100 times of that for a Chinese bank.
Yeah, and I guess I can speak a little more freely because we're not a bank. But all banks are held to 75% loan to deposit ratios, and so the foreign banks have a funding issue, right? If they can't open more branches and get more deposits, they have trouble competing and maintaining that ratio that the regulators require.
So how long before the foreign banks in China, I don't know if you could answer this, in your opinion, how long do you think that until the foreign banks have the playing fields leveled a bit more?
Well, I mean, if you ask officially what's the level playing field, I think it's already there. One of the conditions of China's WTO accession was what they call national treatment, right? So basically, we're treating foreign banks on the same basis as the Chinese bank. So that's why we're all become locally incorporated bank. But reality is, because of the market, especially the expertise of foreign banks, are still very much in like, for example, capital markets, bonds, and fixed income, foreign exchange, versus extending balance sheet, right? So that has a natural disadvantage, but I think it's coming. I'm an eternal optimist, right? I think the market reform, I think will be surprising to the faster side. I think I mentioned all of those, interest rate, foreign exchange, versus bond market development. Those are all coming faster than we had actually originally anticipated. I'll give you one example, right? There are so many foreign companies invest in China, and those are natural client of foreign banks, right? As the market develops, right now, if you look at the pair, CNY, RMB versus renminbi versus foreign, because there's still a control on the exchange rate, slight control, right? The realized annual volatility is probably 2%, versus most of the other currency pairs, if you let them free flow, it's probably 10%, double digit, right? So even you just improve on that, the volatility goes up, the client will naturally feel the need to hedge, and that volume increase will be naturally coming to our business line, right? So all of those, I think, will be paint a very positive picture for us.
Okay, this actually, I will then, it's going quick actually, time, but we were talking about the onshore market. Let's shift to the offshore market. why would I want to invest in the dim sum market without the anticipation of further appreciation of the CNY? Is there any reason to have the dim sum market? From my perspective, a lot of the investment there, and CNH as well to a bit, has been very speculative. Without that anticipation for further appreciation, what's the future of the offshore RMB and dim sum market? You're probably best suited for this one.
I think if you look at the entire kind of offshore market development, the dim sum market is just one of that. Yes, there has been a period of time where you have a one-way speculation of a fast appreciation of renminbi that account for a lot of activities then back.
Well, add some scope.
Sure.
So far, year to date, I think there have only been 3 dim sum issuances, while there's been $33 bonds issued as perspective.
Dim sum bond is not competing with dollar bond, first of all,
Well,
So I think the dollar bond issuance, we got a lot of other explanation as to why, there has been a kind of upsurge in terms of the dollar bond liquidity. Still, dollar liquidity is far exceed the renminbi liquidity in the offshore market, and you do have corporates, interested to tap into a longer dated, fixed income market, which banks have now become kind of more constrained in terms of participating in traditional banking in the international market. But going back to the dim sum bond, if you think about dim sum bonds development, just take dim sum bond. I think compared with 2 years ago, we probably have around 30-40 billion issuance, but now, we have 260 billion. And the entire market is more close to kind of 400 billion if you take into account the renminbi kind of CD, which also will be utilizing the offshore renminbi liquidity. I think right now the currency, the renminbi, the market does take a view is more approaching the equilibrium, but the longer term view is still positive on the renminbi. So in general, people are expecting renminbi to appreciate more slowly, which is good. So any of the activities in the offshore is less speculative, it's more from the underlying genuine growth and demand for the renminbi. Why would people buy renminbi dim sum bond? If you have renminbi in your portfolio, you want to invest, naturally it would be either renminbi cash, renminbi equity, renminbi bond, or renminbi hybrid, or renminbi denominated kind of assets. That is no difference than if you have dollar in your portfolio, what would you invest? So renminbi is just a currency, another currency. So the dim sum bond is actually the renminbi offshore bond is just one of the investment categories. So whether you would at one point of time invest in the bond versus equities or in other structure, depending on the relative risk-reward structure.
Well, yeah, I think, the dim sum bond is just, for the sake of having something out there. So we might, it was, when it started, it was basically short of asset offshore, but you have that, offshore RMB carved out so that they have to create asset base. That's where dim sum bond. But if that's the route, it's not actually interesting at all, right? What is going to be interesting is, the dim sum bond, the whatever you call dim sum bond or whatever, in Taiwan they call it different name, or future in Singapore they will probably have a different name. The key thing is for our renminbi internationalization. I think this is a test for that, right? Whether we can develop something along those lines, I think that is very important. Given that, there is I think if the currency going to become much more equilibrium, so there's a much less of speculation on purely currency appreciation. It has to have an underlying where, for example, multinationals, if you invest in China, you should be able to have a cross-border cash pool where you can fund your earnings in China can probably potentially one day finance your other operations elsewhere, right? Important step going forward. Third-party financing, that is another thing, right? Whether somebody can need money, can raise the money from those who has the money, who doesn't really have an investment need, through a bond issuance in offshore. So that's the third-party financing. That is all going to contribute to the fundamental feature of capital markets, where in the future, when China were to open up on the capital account, this is the important first step. But ultimately, it's all going to go back when the linkage is set, when the pipe from onshore to offshore get bigger, they become totally fungible, right? And that's where, hopefully, in a few years' time, we have a capital account convertibility.
Brian, you want to make one more point on that, and then we'll move away from China.
Will do. From an investor's perspective, we are very supportive of development of the dim sum bond, but the dim sum bond market needs to be more than developed just based on somebody's call on the currency. You can do that through the NDF market. In fact, if you look at 1 year NDFs, the market is pricing in a depreciation of the RMB. But if we look at the dim sum market, liquidity has improved a bit, but a lot of the issuers in the dim sum market are either high yield issuers or unrated issuers. In fact, 42% of the market are unrated. Now, by definition, that limits the number of institutions that can invest in this market. And then it's a fairly concentrated market. 75% of the issuance in the dim sum market are corporate bonds, 20% are sovereigns, and 5% are quasi. So the market needs to develop, and it needs to develop to be a market not as a way for people to punt on the currency, but to make credit calls, interest rate calls, and currency calls.
Now, the other thing that we should talk about is the yen. Very important topic right now. You know, Abenomics, the yen, et cetera. What will the sharp yen depreciation, what impact does that have on Asia as a whole? Does we have any impact on that, Leslie, being our resident economist?
I guess you used the word sharp. In a way, it's sharp, but it's not too far from where it's been over the last couple of years, right? And all indications are, unlike the Swiss franc, the yen where it is around this number is neither overvalued or dramatically undervalued. I think the key question that we are trying to grapple with is, what is Abenomics? Will it lead to a structural change?
Yes.
Clearly, there's a little bit more reason to believe that cyclically, Japan is a positive market, positive for risk assets, therefore maybe not so great for the yen in the strength sense. But we don't know. I don't think there's consensus even in the Japanese government what the structural reforms will be that are necessary. Well, there are three planks to Abenomics, right? One is loose monetary policy. Well, that's quite clear, actually, for the first time. Second is fiscal policy. That's not so clear, and structural policy is not so clear.
Well, that's a big problem because, you know, me personally, I feel without the structural reforms working, and if you just do 1 and 2, that eventually that's going to bring in potentially into question the solvency of the Japanese government.
Right. But again, for markets, if you want a 1-year view, you know, the cyclical view might be quite positive for a while, and I have little doubt. Well, one thing has changed. It's quite clear that the BOJ, the MOF, you know, policymakers are on board on this policy of trying to reflate the economy, trying to convince markets that they should not buy JGBs and they should go down the risk curve. And we see foreigners believing that. I don't see too many evidence of locals acting on that belief yet. I mean, they do believe it in speaking about it, but not in terms of flows. You know, you need, I think, more on the fiscal and the structural to convince Japanese domestic investors to behave differently. But you can get the foreigners believing in the story, and they have.
I think there are two implications to the region. One is a very large developed market central bank is now upping its quantitative easing program when it seemed like the U.S. was probably capped out. People are anticipating perhaps reducing the quantitative easing in the United States beginning next year. Bank of England still doing so, but on the margin. But this is, you know, a new, you know, they were part of quantitative easing, but they're ramping it up materially. which would lead to more foreign money coming into these economies. And I think the second point would be that it will challenge Korea and Taiwan predominantly as they compete against Japan in many product categories.
Yeah, I was actually in Korea last week, and it's definitely a big concern there. I mean, out of all, if you look at the exports between the two countries, Korea and Japan are the most similar. So what if, does anyone have a view on if Korea will implement any capital controls and what the repercussions could be, domino effect, in the rest of the region, if any?
I'll take a shot at it. I think that, you know, with economies growing slower than they have historically been accustomed to, we think ultimately allowing their currencies to take the brunt versus raising interest rates will be the result ultimately.
And I guess, I mean, one of the results of Abenomics is likely higher yields for Japanese government bonds. Can the government afford that? I mean, I think the debt to GDP, interest payments of the Japanese government debt to GDP is about 1.5%. Italy is at about 5%. If JGBs go up enough, you could easily see Japan's debt service payments as a percent of GDP rise above Italy's as a percent of GDP. Right. What happens?
I think the threshold is like 3% or something like that before it becomes unsustainable. I mean, depending on the assumptions you use, but you can calculate these numbers. I think your point is one of the contradictions or unanswered questions about Abenomics, right? In the short term, of course, we do know actually yields, they're going to try to get the yields to collapse, not to go up. But as market participants and as QE rolls off, yields might go up, and then how would the Japanese government pay given the amount of debt they have? The hope, I think, is that you get growth. So like Brian, my short-term concern is that you got more quantitative easing. Asian economies on a whole, roughly speaking, different cycle from the developed markets. We are facing asset price inflation. We are facing inflationary problems. This complicates the problem, especially if Asian central banks do not want to allow the exchange rate to adjust for perhaps good reason, because there is still actually a lot of risk in the world. We shouldn't forget about Europe.
Yes.
We shouldn't forget about the US. You got these pressures, but on the other hand, if Abenomics did work, if Japan goes back to 3% growth, is that necessarily a bad thing, right? Yeah. So this is the question is, how do you get there? And I don't think we as in the market is convinced there's a credible story about how you get there.
Yeah, well, I'm actually impressed. We went practically the entire panel without bringing Europe up until just now. 9 minutes left and Europe made its first appearance. But good point. But outside of Japan, looking at other parts of Asia, what are you guys excited about? Be it India, ASEAN, is there any story out there that hasn't been talked about enough? Or any concerns even, either side?
I will take a stab at that. I think the one risk, it's a risk. It's very hard to handicap for markets. It's geopolitical risk. Mm-hmm. So, you have a Middle East question which impacts oil more directly. And don't forget, in the last 3 years, we have had these shocks, and they have impacted markets. Then there is the situation in Asia, and I don't see any real reason why North Korea or the disputes over the island should blow up into there's no rational reason why it needs to deteriorate, but we always have to be mindful of this potential risk. I am worried about fiscal risks in the developed world, in the US, and of course the very strong dose of fiscal austerity that's being applied in Europe and what that means, and continue to be worried about Europe. I'm not sure. I mean, I'm very clear that the Europeans want to keep the euro together, and the risk to a euro breakup scenario has declined significantly with what the ECB has committed to do. But we have, until we get growth back, we have populations that are not happy. And you need political consensus to keep this together.
So, you know, one thing I look at right now that surprises me is the fact that, you know, implied volatility, VIX in the US, last time I looked at it, which was a couple days ago, was below 12. You have equities rallying around the world, yet commodity prices are falling. Is there any explanation to this discrepancy? Why does this discrepancy exist? Are markets overbought, I guess, some risk assets?
That's what happens when you got central banks printing trillions of dollars a year.
So what happens?
Right? I mean, they're successful. They brought rates down. You've seen people move out the risk curves, and you're seeing environments where risk assets and bonds, risk-free assets, are both rallying at the same time. We're calling that a policy wedge, right? Mm-hmm. That typically doesn't happen. But that's what occurs when central banks not only run extraordinary monetary policies with low rates, participating in the financial markets, and pushing people out the yield curve.
So what happens when it stops? I mean, I guess that's an important question. I've been getting this question a lot too. When does QE stop? Is there any chance that it may not stop, but if this trend in the US continues, people could get a bit more hawkish in the third quarter in the US, which...
Right, but then does Japan take up the mantle, right? Or does the ECB, because of recessionary problems in Europe, take up the mantle? So do developed market central banks keep printing money and take over from the Fed? Somebody else takes over from the Fed and continues to pump money into the global financial system.
Gotcha. It looks like...
Michael, you're looking at me like, what is she doing here? We have a few minutes to go, but I know there is an interest from the floor to ask some questions to our guests. So since we have a few minutes, can we open it up to the floor for some questions? Please stand up, raise your hand. Andrew, I know you had a couple of questions because I saw you writing them down. Over here.
Brian.
Hello. Hello. Hi. I'm Brian Yap from the organizing committee from ACI Singapore. I'd just like to kind of steer the panel back to the impact of China and the rest of Asia. I'd like to get a comment on how fast, if any, would you see the pace of the rest of the Asian governments adopting their trade denominated in the Chinese currency, and possibly how fast they would be embracing the expansion of the Chinese currency government bonds as a natural reserve asset.
Sure.
I can give it a go. Yeah. I think first on the trade side, I do anticipate that there will be a much accelerated pace of renminbi being taken up as a trade currency. I mean, what we've seen since the 2009 opening up, actually up to date is about 12% of China's global trade already denominated in renminbi. We think about the actual trade quantum. Obviously, China's trade with the Eurozone, with the developed world, is still far more than within Asia. But I think to drive the renminbi trade settlement internationalization within Asia has a specific advantage. Imagine if you are an importer-exporter in Asia, say China with Singapore or China with Indonesia or India, you used to bill in, say, US dollar, right? To change that to renminbi, optically or mentally is not that difficult because it was always denominated in the third currency. So it's all about familiarization and actually seeing renminbi as a major global trade currency in the future. I think the challenge with the developed world is more difficult because if an importer-exporter has been dealing with, say, a US counterpart or a Eurozone counterpart, the bill has traditionally been denominated in US dollar or euro. So to actually get it changed to renminbi, then there's got to be some understanding of the benefits of that change, which we've seen, corporates in China willing to pass on some of the benefits of receiving in renminbi to their counterparts in Europe or in America, up to like 3%. So I do expect that probably within the next 3 years, maybe 40 to 50% of the trade within Asia will be denominated in renminbi. And if you take the quantum of the example of, say, in the US or in yen in Japan, now 80% of the US trade is denominated in dollar, and 30% of the trade in Japan is denominated in yen. So going forward, I think the eventual target of, say, 30% of China's global trade denominated in renminbi is a reasonable kind of target.
Anthony wanted to add something.
Well, I believe the answer to this very insightful question really depends on the development of asset classes that the offshore renminbi can actually invest in. I won't use the word recycle back to China, because personally I see that the so-called free convertibility of renminbi, including at the capital account, will not be a very recent event. Many people, including myself, has been saying that we should see the internationalization of the renminbi, but there should not be a too rapid kind of total free convertibility of the renminbi, because I believe China will still need certain restrictions on the free flow of capital accounts. I don't think China is ready for a total free convertibility yet. So a lot depends on the development of the offshore renminbi capital accounts product for these offshore renminbi to invest in. And if the development of all kinds of instruments, including in the equity market, including in the bond market, is developing well, then I think there'll be more incentive for the trading partners to use renminbi for their trade account, as well as taking on renminbi as their reserve currency.
Are we out of time, I think?
Fun Gao has his pen up. He definitely has something to say.
What's that?
Was there something to add from the panel? One more?
No, I think I think we're out of time. Yes, I think the first step will happen in Hong Kong. But if you look at most players there are still Chinese background. Multinationals moving slightly slower. But I think when they are changing their internal structure, meaning making renminbi another currency they have to deal with, and at the same time, you need to have a product, right? When they take up a currency, they should be able to hedge the risk with that currency. That is a capital market development in offshore, in terms of offshore renminbi. That is happening. That is not something any aspiring government want to develop a local sort of a capital market they can do. It's about their clients' initiative. But I think all they can do is to probably help facilitate the process. And going forward, at some point, that is, I think it's going to be infrastructure building is coming. Next year, the Chinese central clearing system for renminbi chips is going to be online. So once all of those infrastructure is built, it's a natural process where.
All right, we're going to leave it on that note. And interesting, we didn't talk about Europe much, but the US was pretty much untouched in an hour and a half, except for a bit of talk about QE2. So obviously, Asia's emerging importance. Anita and gentlemen, thanks very much. Please stay on stage for a moment because we have a representative from the ACI coming up onto stage, Andrew Ng, to present some mementos for your participation. Thank you. And first of all, to Anthony Leung, thank you very much for joining us today. Feng Gao of Deutsche Bank China. Anita Feng with HSBC. Brian Baker with PIMCO. Leslie Teo, thank you very much. And last but not least, panel moderator Michael McDonough. Thank you very much, and we'll take a group photo as well. One group photo before we break for tea. Yes, right here. Great, thank you very much. And it's tea time, so please help yourself. We'll be back with one more session, moving into hedge funds and making some money. Have a good break.